Money Sense, bringing an informed financial perspective to the Cayman community.
A very good morning and warm welcome to Money Sense. Hosting with me, Simon Caudry. This morning is my co-host, Neville Hicks.
Good morning.
Nice to see you, Neville. We are delighted to be rejoined in the studio this morning by Aaron Chan. For those who don't remember, Aaron is a self-described contrarian analyst who runs his own media podcast called Adventures in Finance and is therefore a veritable financial media personality. Aaron is a former JP Morgan investment banking analyst and lives and works right here in Cayman with Real Vision. Now, Aaron, we had you on the show just a few months ago, back in June, and some may wonder why we're having you back on in such a short period of time. But as I understand it, winter is coming and you're going back to the Great White North. What's going on there?
Yes, I'll be leaving Real Vision at the end of August, so I guess next week. I'm going to be working for a family office in Canada as an analyst. So just as autumn sets in, the sun sets earlier, the temperatures fall.
So well, good luck in the cold. It's going to be extraordinary.
No, I'm going to miss the sun.
So today's show, the topic we're talking about are investing lessons, what we can learn from some of the greats of the investment industry, some of the leading gurus. So let's begin by trying to understand who some of those people are and give some context to who we consider some of the investing legends, and then we can talk about perhaps some of the lessons that one can learn from them. So who do you consider some of the investing legends that exist then?
So I think before I get into it, I think I need to preface it a little bit too, because the names I'm going to throw out, they're not names that you've necessarily heard on CNBC or Bloomberg. Some of these people that I've spoken with are extremely private, so maybe some of the listeners won't recognize the names, but some great people that I've spoken to and legends in the industry, typically in the macro industry, like guys like Steve Diggle. Steve Diggle, he made $3 billion for investors in 2008, 2009, shorting. Basically, it was long volatility. He was a volatility trader, had a volatility fund. Guys like Peter Brandt, who basically is a technical classical chartist. He's been trading successfully for 40 years. And if you look at his risk return metrics, guys, I mean, it's phenomenal what he's been able to do over 40 years through various cycles in the market. Guys like Mark Yusko. Mark Yusko, he runs a couple $1 billion for Morgan Creek Capital. He actually recently beat Dan Loeb. Dan Loeb is probably a name that you guys are familiar with in Portfolios with Purpose. No, with Purpose. So, I mean, there's tons of guys I've spoken with. Julian Brigden. So, yeah, I mean, those are the people that I would consider legends in the industry that I've had the chance to work with, to speak with in the last 6 months of producing Adventures in Finance, and to dig into some of the mistakes that they've made in the past, and because that was a regular feature in our podcast.
I guess that's an important point, actually. You don't have to, just because somebody is well known, doesn't necessarily mean that they are someone you should follow. There are many, many smart people who prefer to keep their lives, investing and public lives, to themselves, and yet you can learn incredible lessons from those people as well.
True.
So that is an important thing. So just because somebody appears on TV doesn't always make them the right person to be paying attention to, and that's perhaps a lesson that's well learned when people do watch some of these 2-3 minute sound bites that appear on TV. Just people are on TV for different reasons sometimes.
Right. No, that's a really good point, and I think you called me a contrarian analyst, but when I see someone on TV, my first thought is like, well, if you've got such a great idea, why are you telling the whole world?
Exactly.
But I mean, people come on, they go on Bloomberg, CNBC for many reasons. Either be it to talk up their book, or to gain more media exposure. But yeah, that's typically the first.
We only have people on Money Sense here for the right reasons, obviously. So thank you again for joining us.
How happy to be here.
I'm interested because it's fascinated when you look at people who manage money and then people who manage money for other people. And kind of to your point of if you have such a good idea, well, then why are you working for other people and not just managing your own money? And just curious to know, of the people that, you would consider legends, are they still managing third-party money, or are they now just kind of managing their own wealth within kind of, I guess, unconstrained, doing what they want to do without having to answer to investors?
Yeah, so I think there's a mix of those two things that you mentioned. Guys like Steve Diggle, so Peter Brandt, for example, he's a classical chartist, and he still manages his own proprietary book, so he's running his own money. Steve Diggle, he's basically gotten out of the traditional fund management game, and now he's investing in things like avocado farms, German real estate, UK biotech. He's really diversified and created sort of this real portfolio that actually has like option-like characteristics in terms of their risk and return. But then there are also guys, legends. in terms of managing their own money, but also legends in terms of who they've worked with in the past. For example, Greg Weldon, he used to work at Moore Capital. Others who worked with Louis Bacon, and others who were worked at Tiger. So it's also about who they've had the chance to be mentored by, and sit next to. Some of the legends that people know, like George Soros, Alan Boyce. He worked for Soros. So I would look at those two things in terms of who's actually, I guess, quote unquote, a legend.
So also someone's pedigree and who they've been able to train around. Is what
Right.
you're saying.
Exactly.
And so I guess that's, in some respects, actually, that's perhaps our first lesson for somebody, which is one of the most important things you can perhaps do is listen to some of the smartest people who are out there and get access to their information, whether it be by reading about them, watching video podcasts, or whatever it might be. That's one of the smartest things you can do. Just listen to other people's opinions and views, and don't use their opinions and views, but use that to inform your own opinion and view.
Yeah, exactly. You obviously have to assimilate those things and what you hear, but there really is there's no excuse in this day and age when you have the internet and there are all these podcasts and there are services like, this is not a plug by any means, but services like Real Vision, where you do have access to deep, kind of insightful conversations between people that you normally wouldn't get a chance to speak with or hear from unless you had a lot of money. So.
Do you? I'm curious. When you're having the chance to interview these people and who've been extremely successful in the realm of investing, separating, I guess, getting back to this legends or people you consider kind of what I like to think of time tested. You're not just the flavor of the week or the flavor of the decade.
Right.
Is there kind of a main vein or theme that runs through all of them in a sense of, not just how they invest, but kind of their general, I don't know if it's mantra or philosophy or ethos?
Oh, yeah, and this is, I don't want to sound, it's not self-serving, but when we were designing the podcast and thinking about programming, one of the things that I wanted to do was to create at least a segment where you can get these people on to kind of confess to their sins and just really kind of be honest about the mistakes they've made in the past. And I guess one big characteristic that I've identified is humility, because for people who have been in the game for a long time and have had that longevity, they've had to be able to ride the highs, and they've also been able to ride the lows. And how you can still stay true to your process during the lows, but also recognize that when you're killing it, you have to recognize that there's an aspect of luck there, and then not to be over your ski tips, and still staying true to your process, staying true to your how you look at risk management. So I think that's one thing that I've identified and I've taken away from speaking to all these investors and analysts that I've spoken with is that you spend tons of time building a framework, you have a process, and you stay true to it, and then you also update it. I think John Maynard Keynes said, when the facts change, he changes his opinion, and I think you have to, those who are adaptable, those who are humble, have that longevity in markets.
Interesting. I think something you said there about changing opinion, I think is a crucial point as well. Someone may, a stock or bond or something that someone owns today, you may own it for absolutely the right reasons, but you have to be willing to make a change to your own opinion. You have to be open-minded enough to say, hey, I might have been right a year ago, but my conviction then is not it should not be the same as it is today because other things have changed around me. And that comes to the humility of being able to recognize mistakes or just recognize facts have changed, which you need to be aware of and need to respond to.
Yeah, that's absolutely true. And I think another important characteristic that maybe I've picked up on is that they're willing to engage with people who have different ideas than themselves. Mm-hmm. They're willing to get out of their comfort zone, and maybe this is why some of them will go onto Bloomberg and to CNBC, is that you actually get a chance to air your views, and then you invite criticism, you invite arguments, and you invite other points of view. But just the willingness to engage with others and your ideas and to be honest about what the facts are, I think that's also another important aspect. And I think that draws from the humility side, right? Because if you don't think you have all the answers, which I don't think anyone does, then you are going to go out and seek other opinions and opinions from people that you respect and you trust. Mm-hmm. So I think...
What about the capacity of these people to take risk, to take chances? Because a lot of people may have very good ideas, but may perhaps be too scared to actually do something about them. How have you assessed those people's aptitude for risk taking in that sense?
So obviously, their propensity or comfort with taking risk depends on their how well they've done their research. I mean, most of these guys are not going to put on any kind of position unless they've done the research. Or you're like, for example, Peter Brandt, his process, he sticks to a process he's been using for the past 40 years. Like, all right, if the price breaks out of this technical level, then I'm long. So it can be as simple as that, where like you actually stick to your process and you're going to take that risk. But I think the risk also, the other side of the coin for risk is that position sizing. So say you're less comfortable, you perceive a position or a potential trade to be more risky, but you think there's high reward, then you size your position accordingly. And so the people that I've spoken with, I think they're very sensitive to sort of this scale where the higher the risk, then maybe you size your position 50 basis points of your portfolio or whatever. But I think understanding risk management and understanding position sizing is really crucial in terms of your comfort with the risk on a trade.
All of these people all of these investing legends that you've talked to, they're all very much aware of the fact that you have to be careful about monitoring the risk and also taking risks commensurate with the potential rewards that are going to occur, right. But not put all, to use a terrible cliche, not put all one's eggs in one basket, right?
Yeah. But I mean, there are those who will put 30% of their portfolio into, I know, I think John Burbank is one of those guys. Like, he's long Saudi Arabia, so you're putting significant risk on. I think Soros did the same thing, but there are many different styles, so it's not one size fit all. Guys, so I mentioned like Peter Brandt, he will put like up to 50 basis points to like max 100 basis points of portfolio into a risk position. So it just depends on what you're comfortable with, the kind of trader, kind of investor that you want to be, your time horizon.
What about losses? How do you interpret how these people respond to bad things that happen in their portfolio? So a security that goes down, do these people generally exit those positions, ride it through? What's the general sense that you've got from how these investing professionals respond to those circumstances?
Yeah, a common theme that I've heard is that they cut their losses short because if your ego forces you to like stay in a position longer than you otherwise would, that means that you're not in the game. If you're losing capital, then you're essentially taking yourself out of the game because you can't play it without capital. So they definitely have a willingness to cut their losses short. They have very they'll probably place like tight stops on their positions. Stop is basically just some predefined level where you're like, okay, I will get out of this trade, because it's easy especially for novice traders to get emotionally tied to their positions and be like, say you've done a lot of research and you're like, yeah, like I really think this is a good idea, but if the market tells you otherwise, you got to get out and maybe you have to reassess.
Psychologically, that can be quite difficult.
It is difficult,
and there's lots of people who are not even novice. I mean, who get stuck in trade. I mean, Bill Ackman, Chris Benotti. I mean, it goes on and on.
It does.
And it's interesting, kind of the psyche behind that and why, you can be right about something, but you can still lose a lot of money.
Well, let's take a short break and then come back right after the break and talk about the psychology of that and how to respond to those emotional factors. So just rejoin us again in a few minutes, right after the break, with Aaron Chan as we talk about some of the lessons of the investment legends.
Money Sense, the only personal finance radio show in the Cayman Islands, hosted by Simon Caudry from the CFA Society Cayman Islands.
This is Money Sense.
Welcome back. In the second half of today's show, we are going to continue our conversation on investing lessons with Aaron Chan and hear about some of his biggest fears, perhaps, for where the world is today. Before the break, though, Aaron, we touched briefly on the topic of the psychology of being an investor. And it makes a huge difference if one's able to overcome some of the human frailties that we all generally have when making investments. And how have you assessed how some of the smartest people in the room have behaved and how they've responded to these sorts of factors?
Well, they're people who are, I don't want to say extremely, but their sense of like kind of awareness of themselves and how they're feeling and their emotions is very, very acute. And I think they're also very self-critical. These people they'll assess objectively and honestly the decisions they made and how they, thought process that led up to that decision. And so I think that's why being a great investor, not just a good investor, but a great investor is so difficult, because you essentially have to do all those things that people, everyone else is not willing to do in terms of assessing themselves, assessing your own thought process, and really like, chiseling away at those aspects that you don't like, that cause you to lose money. And I mean, you have to be aware of what's happening in your head to figure out like how you lost money in the first place. And obviously there's an aspect of like doing the technical research, but psychology is such a huge part of that game as well, that most people are not aware of.
Is there a way of what have you found out as the ways of overcoming some of the human psychological frailties that make us bad investors? How are these people doing it? Is it simply by self-analyzing or self-critique? Are there other ways that they go about it? Is there more of a mechanistic, hey, if these things go down, a rules-based system so that you take away the human emotional part of it and say, if this happens, I will do this, or you make a computer do it for you?
Robots, yeah.
Yeah, I mean, I think we kind of alluded to this before the break. I mean, exposing yourself to divergent ideas, variant perceptions like that, you could probably do that, and it would make you more comfortable with like being wrong. Like there are ideas out there that maybe that you haven't thought of. So exposing yourself constantly to different ideas, I think, is one way that you can kind of buffer it. But also, systematizing it and making sure that's like, for example, just having a stop. Like, okay, if it reaches this price, then I'm wrong, and I'll get in my position. You essentially, and you said it right there, Simon. You have to set kind of rules for yourself where it's like, okay, if this happens, then I'm out of this trade. So I think there's a mix of both that you can employ, that just for retail investors can employ. But I think the more difficult one is a psychological one, because like it's easy for us to kind of put in rules, but then you still have to abide by those rules, like because you could override.
You still need to actually put that limit in, or sell.
Right. So yeah, it's kind of, long story short, it's very difficult.
But just touching on, kind of backing up a bit, Aaron, on I'm always interested to understand how media has transformed the finance industry and the investment industry. And, I look at Twitter now, and you can follow us at MoneySense. Send your questions there. But it's, collaborating and understanding, getting different people's views is important. How do you think, social media or Twitter and access to information, like even Real Vision's podcast, your podcast, how do you think that shaped people getting different perspectives on ideas and maybe kind of challenging someone's investment thesis?
So it's going to sound contradictory, but on the one hand, I think it has a big impact, it has a massive impact. But on the other hand, it doesn't, because some of these, and we experienced this with the Trump election. I mean, you can effectively create your own echo chambers. Right. So that is that's an argument for it being significant, and also an argument for it not being significant. But I think technology is a poor master, at least right now, and that's a result of human psychology and how we interact and transact with technology. But I think something like Twitter, for example, I mean, I live on Twitter, and we're now flooded with information in the world. It's instantaneous, but I think where the true value is in curating that information and then turning it into knowledge, turning it into insight. And just because we have a flood of data, we have a flood of information, that makes that job of curating and figuring out, okay, this is what's important, this is a signal. I mean, this is an overused phrase, but what's a signal and what's a noise? There is still a tremendous job to be done there. So I would argue, on balance, probably social media and technology has maybe increased the noise versus the signal, and people who can differentiate, and this is what I think you mentioned, kind of like back testing some of this stuff, like who has a good idea, is like how do you find those people? It's all possible, but you really have to go down the rabbit hole and then start tracking, as opposed to just.
I think one also has to be incredibly careful in a world today where it's so easy for people to publish opinion, publish viewpoints. Right. One has to be incredibly careful to be discerning about understanding that somebody's opinion, as well argued and articulate as it might be, may have no factual basis whatsoever. And so just because you read something which looks compelling doesn't mean that their argument is actually sustainable or substantive in any way. Right. And how does one do that in today's climate where there is so much information? Because it could mean that you have to go and read 10 times what you might have read before. That must be a real problem.
Yeah, it is a problem. And I guess one paradigm that I like to come back to solve that problem is Nassim Taleb, and he's been tweeting a lot about skin in the game. Like, do people have an incentive? What are their interests behind what they're doing? And I think you just have to ask that question, like, okay, what does this person have skin in the game? know, do they have risk on, and how does that correlate, and how does that like match up with what they're saying,
or how is it aligned with you, the investor?
Right.
If you're investing with a manager.
But that just even asking that question is difficult because, you know, there's publishers and news sites, like they're all playing the same game of like being first and being fastest when it comes to, you know, putting out a headline or whatever. So, you know, you're reacting to their stuff and you're just taking in a bunch of information without stopping to actually ask those questions. So, and that's why I say technology is a poor master, because like right now it's kind of mastering us as opposed to the other way around.
I think
so you mentioned, I'm curious. So you mentioned you live on Twitter. What, you know,
I don't actually live on
no,
Twitter.
I know. But what are kind of, I guess, what are your main kind of uses, or how do you kind of go through the noise and
yeah, so
or navigate through the system? Because the amount of information is bananas.
It's staggering. It literally boggles the mind. I think, you know, there are many strategies to do this. One of the things I like to do is like to create like lists. So not just like, you know, checking out my home feed and like who I follow. I mean, I try to keep the people that I follow to like a very select group. Not because I'm some kind of snob, but just because, like, you know, I'll follow certain people and love interesting things to say. Some are like more political. I'm like, okay, yeah, like I'm not here for that stuff. So you have to kind of do your own filtering and do your own curation. Right. But you know, I really like Twitter for kind of idea generation. Somehow, Twitter's stock has done terribly, but it's actually almost the ideal platform for finance, because you can post like charts and you can kind of create these little small presentations with like, you know, small snippets. So it is kind of sound bites, but it forces you to try and put all your insight into the 140 characters. Another thing that I try to do is to find mentors as well on Twitter. I mean, there are some really smart guys, you know, global macro portfolio managers who are on Twitter. I mean, they're anonymous, but like, you know, they're very generous with their time and their insight. And so I've been able to meet some people that I otherwise wouldn't be able to meet, and you know, get their advice on Twitter. So
in essence, I'm hearing you use it as a research tool as opposed to a decision-making tool. You don't look at Twitter and say, someone says this, I must do it. That's an input into your research process.
Yeah, absolutely. And also, you know, cognizant of the fact that it is in some ways my own echo chamber. Like I try and you know, find the divergent opinions, and I mean, even then that's a little difficult, because it's like, you know, I'm trying to find what's true, and what I think is true may not be what,
sure,
you know, right? So you're also just, I'm very aware of the fact that like my feed is an echo chamber of sorts, and then balancing that. So yeah, I'm definitely not making decisions, but also trying to get what the sentiment is as well in a particular community.
We only have a few minutes left, and with the interests of something you said a moment ago, which was skin in the game, tell us what you think. Well, from you personally, then, are most interested in at the moment as an investment idea?
So obviously, these are my opinions, not the opinions of Real Vision or, you know, my employer, Future, or otherwise.
Or even Money Sense, if we're putting caveats in here. Why
exactly.
not?
I don't know.
Or Radio came out.
Do we have a disclaimer?
Talking about content. Right?
Yeah. So this is, you know, the biggest position I have in my portfolio is not very sexy, but I think is a good risk reward trade. You know, just long bonds. So I'm long 10-year bonds. But the other trade that I have on that I'm you know, I think is compelling is I am basically short Brazil, and I'm short Brazil because I think. And
short means that you think Brazil is going to perform very poorly.
Yes, I think Brazil is going to perform poorly for a multitude of reasons. U.S. dollar, China. I think the commodity complex is also turning. It's reached an inflection point. So, you know, the liquidity bounce that we've had since the last quarter of 2015, I think, is now finally reached maybe the third and last phase of rolling through the system. And with all the central banks around the world, I mean, European Union's talking about this, ECB is talking about tightening policy. I just don't know which central bank is going to step up next to inject liquidity, when all of them are trying to follow the Fed's lead in terms of like rate normalization and balance sheet reduction. So I think there's that, and then you also have the political fiscal headwind of, you know, the debt ceiling that's going to come up in like October. So I see a whole host of risks that make me think that, you know, I don't know, in terms of a risk reward perspective, I like that.
Talk a little bit about the. Are we running out of time?
Well, we are running a little bit out of time. 30-second answer then, Neville. Go on.
No, I just you mentioned commodities and kind of that coming to a head. What in 20 seconds? What do you mean by that?
So I think, oh man, it's actually much easier for me to explain these things in charts. But I think when you look at some leading indicators, how do I say this? Some of these commodities, I mean, because they are smaller markets, they show divergence from like the rest of the market. I mean, look at iron ore. I'm getting the eyes from Simon. We can share this offline, but yes, it's stuff like that you're seeing a very clear divergence between. I mean, you can even look at a commodity index. Some of this stuff. You can look at currencies, for example, dollar Aussie, right? You can look at that as sort of a proxy for some of the commodities. I mean, that's also diverging from some other indices. So when you see those sorts of signals, then it kind of gives me pause. And
well, I'll tell you what. How about this? We'll put a link to your Twitter thing on our Twitter thing after the show. You can put a chart up explaining the link. I don't know what I just said there, but it seemed profound at the time. We are unfortunately, as always, running way close to the end of time. And Neville, I know you have a few words you wanted to mention about the upcoming investment forum as a good opportunity, perhaps for people to learn a bit more about the investment industry. Do you want to say?
Yeah, we're hosting the CFA Society Cayman Islands is hosting the 5th annual Cayman Investment Forum. That's October 11th at the Ritz-Carlton. You can. It's going to be great. We've got 5 guests coming down to give us some insight, really, on money and the history of money and different types of forms of money. So we're going to be talking about anything from fiat currency to commodities to Bitcoin and cryptocurrency, which is certainly a hot topic now. And it's our goal to get a couple of these speakers on the show prior to them visiting Cayman. We'll have to figure out how we're going to do a live feed, but it should be really good. If you want any additional information, please go to CaymanInvestmentForum.com. You can register online there, and I strongly suggest you check it out because it's going to be another great event.
Absolutely, and having been to almost all of the previous ones, I obviously totally agree with that. We are, regrettably as always, out of time, however. So, Aaron, thank you very much once again for joining us. And obviously want to mention that information that you've been talking about is often available on your podcast series, and some of the topics that we've talked about are on there. Just remind us the name of that again, please.
Yeah, absolutely. The podcast is called Adventures in Finance, and you can find us on iTunes. You can just Google Adventures in Finance, and Season 2 is coming out September 7th. We have a lot of big guests lined up, and we're going to come back bigger and better.
Just like Game of Thrones, bigger and better in the next season.
There we go.
Right. So as a final note before we leave, just want to thank all of our listeners and remind you today's show will be able to be heard as a podcast as well on the CFA Society Cayman Islands webpage. One day we'll investigate what iTunes is and see if we can go on there. Encourage anyone who has a question or topic to email us at moneysense@candw.ky or send us a tweet at moneysenseradio.